the quiet rivalry behind a billion-dollar reversal. It started with two investors who were never supposed to cross paths. One built his reputation on caution, studying risks with the patience of a surgeon. The other thrived on bold moves, chasing opportunity with fearless precision. They lived in different worlds, followed different principles, and built different kinds of empires. Yet one quiet rivalry between them would set off a chain of events that reversed a billion-dollar trend no one thought could break. To understand how this happened, we need to revisit a moment when the market moved in one direction with absolute certainty. For months, prices climbed relentlessly. Analysts praised the trend as unstoppable. Funds poured in without hesitation. It was a wave so powerful that even skeptics were forced to ride it. But in every wave, there are two kinds of investors: those who follow momentum and those who study its foundations. This story matters today because markets still fall in love with certainty. Crowds still believe trends will never end. And somewhere behind the noise, there's always someone questioning the pattern while everyone else celebrates it. That's where this rivalry began. The first reveal starts with a cautious investor. He noticed something strange in the data, a growing gap between the market's optimism and the underlying fundamentals. Companies in the trend were overvalued. Leverage was rising. Supply chains showed stress. Yet prices continued to climb as if none of those cracks existed. He began preparing quietly, building a hedge, not out of fear, but out of discipline. The second reveal unfolded on the other side of the market. The bold investor wasn't studying the cracks. He was studying the psychology. He knew the trend was nearing exhaustion not because of the numbers, but because of the crowd's behavior. When everyone acts certain, volatility waits in silence. He began reducing exposure, but discreetly. No announcements, no warnings, just subtle shifts that only the most attentive could detect. The third reveal came when their paths collided through a shared counterparty. Each investor made adjustments that seemed unrelated, but when combined, they sent ripples through a niche corner of the market, a corner sensitive enough that small changes triggered outsized reactions. Neither investor intended to influence the broader trend, and yet their quiet moves began to destabilize a wave the entire market trusted. What neither investor realized was how interconnected their actions had become. The cautious investor's hedge triggered small adjustments in derivative pricing. Those adjustments, in turn, affected liquidity in the instruments the bold investor had quietly begun unwinding. Together, their independent moves created distortions that algorithms noticed long before humans did. And in a market running on automation, distortions don't stay small for long. The bold investor sensed a shift first. He watched his spreads widen at odd moments, not enough to raise alarms publicly, but enough to signal that someone else was preparing for a change. His instinct sharpened. He didn't know who was behind the move, but he recognized a signature of disciplined caution. Someone out there wasn't buying the narrative anymore. The conflict deepened when the cautious investor reviewed updated models and found volatility rising in pockets that were normally stable. The data didn't match the market's bullish narrative. Something or someone was quietly pulling liquidity out of the trend. He didn't know the source yet, but he recognized the pattern. A competitor preparing for the same break he anticipated. Both men continued adjusting their positions, unaware that each move amplified the other. A small hedge here, a reduction there, a shift in long-term exposure matched by a change in short-term flows. Their rivalry was invisible, unspoken, yet powerful, and the market, still convinced the trend was invincible, had no idea two strategic minds were quietly preparing for a reversal. The pressure intensified when liquidity providers reacted. Algorithms detected inconsistencies and widened spreads further. Market makers hesitated to take large positions. Funds that relied on smooth execution found themselves facing unexpected friction. The bid-ask spread told a story no headline captured. Confidence was thinning. Rumors began to circulate in private channels. Someone big was repositioning. Some fund was hedging aggressively. Some trader was reducing exposure to sectors everyone else believed were bulletproof. No one had facts, only guesses. But guesses were enough to spark unease. The cautious investor noticed a shift in tone. The bold investor noticed a change in volume. Each interpreted the signals through his own philosophy, but they both reached the same conclusion. The market was approaching a tipping point. Then came the spark that crystallized a conflict. A mid-tier institution, heavily exposed to trend, suddenly issued a cryptic earnings revision. Not catastrophic, not dramatic, just uncertain enough to shake the illusion of invincibility. The cautious investor braced for impact. The bold investor accelerated his exit. Their rival strategies, once subtle, were now in motion at full speed, and the wave the market trusted began to tremble. The trembling spread faster than either investor anticipated. Markets that once moved with smooth confidence now flickered with hesitation. Trading volume spiked at strange hours. Spreads widened without warning. The trend that had dominated the year began losing its rhythm, not in a collapse, but in a quiet stutter, like an engine misfiring before anyone hears the explosion. Inside the cautious investor's office, alarms as models lit up one by one. Correlations that held steady for months broke apart. Volatility leaked into sectors that were supposed to be insulated. It was a kind of fragmentation that only happens when confidence begins to drain from the edges inward. He didn't smile or celebrate. He simply prepared. The reversal he had anticipated was no longer theoretical. It was unfolding. Meanwhile, the bold investor studied the psychology of the market with growing intensity. He saw fear hiding beneath the surface. Fear disguised as optimism, as denial, as forced enthusiasm. Traders talked louder, but with less conviction. Analysts doubled down on bullish explanations that suddenly felt strained. The bold investor knew the signs well. When people argue this hard for certainty, it's because they feel the ground shifting beneath them. The conflict sharpened when a major fund began quietly selling portions of its exposure. Not enough to trigger alarms, just enough to add weight to the growing imbalance. It was the kind of move only insiders noticed, but both investors saw it instantly. For the cautious investor, it confirmed the structural cracks he had been tracking. For the bold investor, it confirmed a psychological break in the crowd. Pressure built across the system. Market makers pulled back further. Execution time slowed. Large orders slipped through at worse prices than expected. Every sign pointed to a market struggling to maintain its illusion of stability, but the broader public remained unaware. Headlines still celebrated the trend. Commentators still framed concerns as short-term noise. The tipping point arrived when an unexpected surge of sell orders hit the market, small in size, but concentrated in the most sensitive corner of the trend. Algorithms reacted instantly, widening spreads and dumping correlated positions. The cautious investor watched the cascade with a calm, almost analytical detachment. The bold investor watched with the clarity of someone who had prepared for this exact moment. But then something neither expected occurred. The actions of both investors converged in a way that accelerated the reversal. The cautious investor's hedges amplified downward pressure. The bold investor's exit magnified liquidity imbalances. Their strategies, designed independently, now reinforced each other with perfect, unintended symmetry. The market lurched. Prices didn't dip. They snapped. A clean, unmistakable break in the trend line that billions of dollars relied upon. In one sweep, confidence evaporated. Funds rushed to unwind. Analysts scrambled for explanations. Traders stared at screens trying to understand what had just happened. The quiet rivalry had become the spark. And now, the entire market was caught in the recoil. The break triggered chaos within minutes. Prices that climbed for months began falling in sharp, uneven waves. Funds that had grown complacent rushed to hedge, but liquidity vanished faster than they expected. Algorithms fired off defensive orders, with no one on the other side to catch them. What had once been the market's most reliable trend was now its most dangerous fracture. The cautious investor held his position steady, watching the reversal unfold exactly as his models had predicted. His hedges surged in value, not because he sought profit, but because he prepared for reality others refused to see. Every chart that turned red confirmed the same principle he had always followed. No trend is invincible, and no market is immune to its own excesses. Across the city, the bold investor moved in silence. He didn't celebrate the fall. He didn't gloat. He executed the final part of his plan. rotating into assets the crowd had ignored, the ones that never benefited from the wave in the first place. While others panicked, he targeted opportunity. For him, reversals weren't moments of fear. They were moments of clarity. The climax hit when the market's bellwether company, once a symbol of the unstoppable trend, announced a sudden downgrade. The statement was short, almost apologetic, but its impact was seismic. It confirmed what the data had been whispering for weeks. Growth had peaked, momentum had reversed, and stability had been an illusion. The billion-dollar trend broke in a single breath, and the shock rippled across global markets. In the aftermath, commentators scrambled for explanations. Some blamed algorithms. Others blamed institutions. A few suggested manipulation. But the truth was quieter, simpler, and far more revealing. Two investors, acting independently, had seen what the market refused to admit. Their rivalry didn't create the reversal. It exposed a fragility that was already there. As the dust settled, both men reviewed the aftermath. The cautious investor noted how quickly euphoria turned to fear. The bold investor reflected on how few recognized the psychological tipping point until it was too late. Neither sought credit, neither wanted attention. They understood that the market story was bigger than any individual. The resolution came a familiar lesson. Trends rise on confidence, but they fall on truth. And the truth always arrives quietly, through data, through behavior, through the actions of those who think independently when the crowd moves as one. Sometimes the smallest shift in perspective becomes the beginning of a new future.